You are probably driving on the highway right now, or, maybe you were earlier today, passing just dozens of those massive
Oh,
18-wheelers.
yeah, they're everywhere.
Right. You see them everywhere. I mean, they are hauling groceries, electronics, raw building materials. It is this incredible, highly visible kind of roaring machinery of the global supply chain. But there is a huge, invisible question hovering over every single one of those trucks.
And it's a question most people outside the industry never even think to ask.
Exactly. The question is, what guarantees that the driver actually gets paid by the middleman who arranged the load? Today, we are pulling apart some really fascinating material. We've got excerpts from a breakdown titled Surety Bonds and Financial Responsibility in Modern Trucking.
Which I know sounds like a real page turner.
I mean, yeah, the mission of this deep dive is to demystify a financial instrument that, frankly, sounds incredibly dry at first glance, the surety bond.
What?
But once we crack open the mechanics of how this works, you will see how this seemingly boring piece of paperwork acts as the invisible, high-stakes safety net, keeping the entire North American freight industry from outright collapsing.
It really is the ultimate financial backstop. I mean, if you remove it, the physical movement of goods just grinds to a halt. The financial risk of hauling a load thousands of miles for a broker you've never even met would simply be too high for any rational business owner to, turn the ignition key.
Okay, let's unpack this. Because before we get into the massive regulatory upheaval that hit the logistics industry in early 2026, we need a solid grasp of what this financial tool actually is. And more importantly, what it isn't.
Right. That distinction is crucial.
Because my immediate assumption, and I imagine the assumption for a lot of people listening to this, is that this is basically just like car insurance for a freight broker. Like, if the broker mismanages their money or goes bankrupt, their insurance policy just kicks in and pays the trucking company. Simple as that.
Yeah, and that is the most common assumption, but it fundamentally misunderstands the mechanism of the bond. A surety bond is absolutely not insurance.
Wait, really? It's not insurance at all?
Not at all. Think about it like this. When you buy commercial liability or auto insurance, you are paying a premium to transfer your own risk to an insurance company. You, the policyholder, are the one being protected.
Right. If I crash my car, my insurance fixes my car.
Exactly. But a surety bond does not protect the person or the company buying it. It is a three-party financial guarantee, and it is designed to protect everyone except the purchaser.
Oh, wow. Okay, so it's more of a legally binding voucher then. If it's three parties, let me see if I can map the architecture of this out. First, you have the principal.
Yes, the principal.
And that would be the business actually forced to purchase the bond, right? Like the freight broker or the trucking company.
Spot on. That's party number one.
Then you have the obligee. I'm assuming that's the government, like the entity requiring the guarantee, like the Federal Motor Carrier Safety Administration or the FMCSA in the U.S.?
That is correct. The FMCSA dictates the rules of the road, literally, and requires the financial assurance before they'll grant an operating license.
Which leads the third party, the surety, the massive financial institution that actually issues the bond. So the principal pays the surety to guarantee to the obligee that they won't break the rules or stiff their contractors.
Exactly.
So the bond protects the government agency, and by extension, the third parties, like the actual truck drivers who burn the diesel to haul the freight.
Precisely. It protects the obligee and those affected third parties from financial loss caused by non-payment or regulatory violations. But here is the critical divergence from insurance, right? The real teeth of the mechanism.
Okay, what is it?
If a claim is filed and the surety has to pay out a truck driver, that is not the end of the transaction. The surety turns right around, uses their legal weight, and seeks absolute full reimbursement from the bonded company. It is a guarantee of payment to the public, not a shield for the broker.
Oh, man. So the surety pays the driver to keep the supply chain moving, but then they immediately come knocking on the broker's door demanding that money back.
With very aggressive recovery tactics, yes. They will go after personal assets, corporate assets, whatever it takes. And in the trucking world, there are two primary architectures for these broker bonds. You have the BMC 84 and the BMC 85.
Okay.
And they represent two completely different philosophies on how a logistics business manages its cash flow and its risk.
Let's break down the BMC 84 first, because this seems like the more traditional approach.
Yeah.
You don't have to put up the full required amount of the bond in cash. Instead, you just pay an annual premium to a licensed surety company. You are essentially paying them a fee to rent their pristine balance sheet.
Right. And that premium is heavily stratified based on your financial health. The underwriting process is really rigorous. I mean, the surety is extending unsecured credit, essentially.
So they're taking a risk on you.
Exactly. So if you are a freight broker with excellent credit, say a score well above 700, solid time in business, really strong liquid assets, your estimated annual premium for a BMC 84 might be a fraction of the total bond, anywhere from maybe $563 to $1,200.
Wow, that is a negligible business expense. You pay $1,000 and you get the federal stamp of approval to operate.
Yeah.
But wait, what if you are a high-risk applicant, like a brand new startup or, I don't know, a broker with a couple of tax liens and a 550 credit score?
Then the math changes violently. You are looking at $4,500 to over $9,000 every single year just to maintain the bond. Because the surety looks at that profile and calculates a high statistical probability that you will default on your payments to carriers.
Yikes. So it's a massive penalty for being risky.
Oh, absolutely. And if the profile is weak enough, the surety won't even accept the premium alone. They will demand collateral like a letter of credit or cash covering the entire bond amount sitting in their accounts before they issue the paper.
Which is actually a perfect segue into the BMC 85
Yeah.
because the BMC 85 bypasses that traditional surety premium entirely. You aren't renting a balance sheet. You're using your own.
Yes, exactly.
But it requires a staggering $75,000 upfront cash deposit placed into a trust fund.
Or approved financial assets of that exact value. Yeah. You park that money in a trust and the trustee just holds it as the guarantee.
That seems like an incredibly aggressive hurdle. I mean, imagine being a logistics startup. You need money for software, for office space, for payroll to hire dispatchers. Taking $75,000 of your working capital and just burying it in an untouchable trust before you have even booked your first load, that feels like a massive anchor on your growth.
It is a severe drag on liquidity. That is precisely why the BMC 84 is the dominant choice for startups, while the BMC 85 is generally utilized by massive established logistics firms.
Yeah. Right, the ones with deep pockets.
Yeah, companies that have millions in cash reserves and would rather tie up $75,000 than pay an unrecoverable yearly premium to a third party. What's fascinating here is...
Wait, actually, whether a broker takes the BMC 84 route and pays a premium, or the BMC 85 route and locks up cash, the absolute floor of the conversation is $75,000, right? That is the magic number, the regulatory minimum security required by the federal government to operate as a freight broker.
Exactly. What's fascinating here is how that static $75,000 threshold, combined with a, frankly, painfully slow regulatory apparatus, created a system that was absolutely ripe for systemic abuse.
Okay, here's where it gets really interesting, because the dollar amount of $75,000 did not change in early 2026. The financial requirements stayed exactly the same.
Right. The number didn't budge.
Yet, the regulatory landscape underwent its most significant transformation in decades. If the dollar amount is identical, why did the entire industry view 2026 as this massive, disruptive, new era of financial responsibility?
Because the transformation wasn't about the amount of money, it was about the velocity of information. We saw a fundamental shift from a passive, slow-moving filing system to an active, automated tripwire.
An automated tripwire.
Yes. And to appreciate the magnitude of this shift, you have to understand the operational chaos of the Wild West, which is what we call the period before these rules took full effect on January 16th, 2026.
The era of silent failures. Let me trace the mechanics of a silent failure, and you tell me if I have the anatomy of this right.
Go for it.
Let's say a broker's business starts tanking. They start stringing carriers along, extending payment terms from 30 days to 60 days, then to 90. The unpaid truck drivers eventually realize they are being scammed, so they bypass the broker and file claims directly against that broker's $75,000 bond.
Correct. The surety investigates, verifies the debts, and starts writing checks to the trucking companies out of that $75,000 pool.
Right, and eventually those claims drain the bond completely. The balance hits $0. But, and this is the terrifying part, before 2026, the broker could theoretically just keep operating.
They absolutely could.
They could log into the load boards, book new freight, and hire new drivers for months because the FMCSA systems were entirely passive. A small, independent trucking company would look up the broker on the federal database, see a green check mark next to their operating authority, and just take the load, completely unaware that the broker's safety net had already been secretly obliterated.
The distress of the brokerage was functionally invisible to the broader market until the collateral damage is already catastrophic. I mean, the regulatory body simply did not have a real-time data link with the surety providers to know the money was gone.
But the 2026 reality completely rewired that architecture. The system was automated. If a broker's available financial security falls below that $75,000 threshold, even by a single dollar because a minor claim was paid out, the new rule mandates that the FMCSA must immediately automatically suspend the broker's operating authority. No grace period, no manual review.
Immediate suspension. You are instantly locked out of legally brokering freight. But going back to your earlier point about the velocity of information, for the government to suspend a license immediately, the data has to travel instantly.
Right.
And that is the second massive pillar of the 2026 changes. The burden of enforcement was placed squarely on the shoulders of the surety providers.
They became mandatory reporters.
Exactly. They were no longer allowed to be passive financial entities that just paid claims and mailed in quarterly reports. As of January 16th, 2026, if a surety pays a claim that dips a bond below $75,000, they have a strict 2-business-day window to notify the FMCSA via email.
2 days. I mean, in the world of corporate finance and legal reviews, 48 hours is blisteringly fast.
It's basically light speed for these institutions.
And this isn't just a subjective feeling where the surety thinks the broker is struggling, right? There are hard, specific triggers for when this mandatory reporting kicks in.
Yes, there are 4 specific triggers.
The first is a consent drawdown, which is straightforward, right? The broker looks at the claim, admits they owe the driver, and agrees to let the surety pay it from the bond.
Yeah, that's the easy one. The more aggressive trigger is the non-response.
Okay, how does that work?
If a carrier files a legitimate claim with the surety and the broker ignores the formal notice for 7 business days, the surety pays the driver. The broker's silence is treated as admission, and that 2-day reporting clock to the government starts ticking instantly.
Wow. It's a brilliant mechanism to stop bad actors from just ignoring their mail to buy time.
Exactly.
And the reporting also triggers if there is a court judgment forcing the payment, or if the broker hits insolvency, meaning they are demonstrably failing financially or formally declaring bankruptcy. So the surety essentially acts as an early warning radar system for the entire supply chain. Once that alert hits the FMCSA and the broker's authority is suspended, they are hit with the replenishment requirement.
Which is an incredibly tight leash. If claims reduce that bond below $75,000, the broker must replenish the funds, top the bond right back up to the absolute limit within 7 business days.
Only 7 days.
7 business days, yeah. If they fail to inject that cash or secure a new bond within a week, the surety reports the deficiency again, and that automatic license suspension becomes entrenched.
So what does this all mean? If I'm playing devil's advocate here, a 7-day window to come up with potentially thousands of dollars in dispute money could absolutely sink a young, legitimate company dealing with a bad week of cash flow. Is the government just trying to make it impossibly hard for an independent logistics startup to survive?
It feels like that, doesn't it?
It feels like they are building a moat for the mega brokers.
Well, it is a harsh, unforgiving timeline. There is no denying that. But if you look at the scale of the crisis leading up to 2026, this wasn't a targeted attack on startups. It was a desperate, absolutely necessary strike against rampant fraud and cascading financial collapses. The FMCSA just had to stop the bleeding.
Let's look at that fraud, because the causes of these bond claims really illustrate why a sledgehammer was needed. The baseline cause is standard non-payment, right? A broker gets paid by the shipper, say, a massive beverage company shipping pallets of soda, but the broker just absorbs the cash and ghosts the trucking company that actually hauled the soda.
Yeah, that's your run-of-the-mill theft.
But the real rot in the system, especially peaking around 2024 to 2026, was the explosion of double brokering.
Ugh, the double brokering epidemic. It fundamentally eroded trust across the entire network.
Let me see if I can explain the mechanics of double brokering, because it's basically a high-speed arbitrage scheme.
Let's hear it.
Let's say I am a legitimate, honest freight broker. I have a load of electronics that needs to go from Chicago to Dallas. I post it on a load board, and a company reaches out. I verify their credentials, everything looks fine, and I hand them the load, assuming they're a trucking company whose driver's going to show up at the warehouse.
But they are not a trucking company. They are a fraudulent entity operating under a stolen or fake motor carrier number.
Right. So this fraudster immediately turns around, pretends to be me, and rebrokers that exact same load to an actual hardworking truck driver. The real driver picks up the electronics in Chicago and delivers them to Dallas. The shipper sees the load is delivered and pays me. I take my honest margin, and I pay the fraudster thinking they did the work.
And then the fraudster vanishes. They disconnect their phones, liquidate the bank account, and just disappear with the cash.
leaving the actual driver who burned $1,000 in diesel completely empty-handed. So that driver has no choice but to file a claim against my bond or the fraudster's bond if it even exists. That kind of layered deception, combined with identity theft and phantom brokerages, it created a tidal wave of claims that the old passive system simply couldn't handle.
Exactly. And to combat this, the 2026 rules didn't just speed up the reporting timeline, they surgically targeted the very structure of the BMC 85 trust funds, completely rewriting who was allowed to hold the money.
Oh, the trustee restrictions. This is a critical mechanism. Historically, a broker could use a non-bank finance company to hold their $75,000 trust. And this was a massive loophole. You would have unregulated LLCs holding dozens of these $75,000 deposits.
They were basically shadow banks. They would take the trust money, commingle the funds, and invest it in high-risk, high-yield assets to skim the profit. But when a wave of claims hit and multiple truck drivers needed to be paid out, those unregulated finance companies suddenly didn't have the liquid cash.
Because it was all tied up.
Right. So as of 2026, those non-bank finance companies are largely disqualified from holding these funds. The new rules dictate that only federally regulated institutions can act as trustees.
So we were talking strictly about FDIC-insured banks, federally regulated trust companies, and NCUA-regulated credit unions.
Exactly. You cannot hand your $75,000 security deposit to your buddy's unregulated finance firm anymore.
That makes total sense.
And the oversight goes a step further. It isn't just about who holds the money, it explicitly dictates how they hold it through the new liquidity rule.
Oh, right. BMC 85 assets must now be liquid within 7 days. The approved assets are strictly cash, Treasury securities, and FDIC-insured letters of credit.
Which is huge.
Because the old system was like trying to pay a sudden emergency hospital bill with a deed to a timeshare. Sure, the timeshare technically has value, but you can't hand it to a doctor. If a driver needs to be paid out of a trust fund today, the government demands that the cash is actually there, insulated from market volatility, and accessible immediately.
If we connect this to the bigger picture, this regulatory crackdown isn't just dropping the hammer on rogue brokers, it is placing immense pressure and massive legal liability on the surety providers themselves. I mean, the entire architecture relies on the sureties reporting these drawdowns within 48 hours. So the obvious question becomes, what forces a multi-billion-dollar surety to comply so aggressively?
Existential threat, honestly. The penalties are fierce. The 2026 rules establish that if a surety or a trust provider violates the reporting rules, say, they pay out a claim and fail to email the FMCSA about the drawdown, they face an immediate 3-year ban from providing financial responsibility instruments in the federal trucking industry.
A 3-year exile.
Yeah. No surety company is going to risk losing their entire logistics portfolio just to cover for a struggling freight broker.
They are heavily incentivized private auditors now. And for the brokers operating without the required $75,000 security or trying to operate while their authority is suspended, well, that triggers devastating civil penalties. Thousands of dollars per day in fines. It creates an airtight compliance dragnet that practically eliminates the shadows where bad actors used to hide.
Now, broker bonds are definitely the heavy hitters of this new era, but we cannot ignore the other side of the compliance coin, permit bonds. Because a truck driver isn't just interacting with freight brokers. The moment they turn the key, they're interacting with physical infrastructure, state borders, and complex tax systems across multiple jurisdictions.
Right. Broker bonds protect the supply chain participants. Permit bonds protect the infrastructure and the state revenue streams.
Let's look at the mechanics of a fuel tax bond, which is tied to the International Fuel Tax Agreement, or IFT. This is such a fascinating mechanism. If I am a truck driver, I might buy, say, 300 gallons of cheap diesel in Texas, but then I drive my massive 80,000-pound rig across New Mexico and into California, burning that fuel the whole way.
You are putting massive wear and tear on California's highways, but you didn't pay any fuel tax at a California pump.
Exactly. IFTA is the system that calculates how many miles I drove in California and forces me to pay my fair share of taxes for using their roads, regardless of where I actually bought the diesel. If a carrier has a history of dodging those tax bills, the state will require a fuel tax bond. It guarantees the state gets its highway maintenance money, even if the trucking company goes under.
We also see oversized and overweight permit bonds, like If a carrier is hauling a massive piece of mining equipment or a prefabricated house, states require a bond to guarantee that if the truck damages a bridge or destroys a guardrail, the taxpayers aren't left holding the bill for the repairs.
Add in customs bonds for crossing the border and household goods carrier bonds, which protect everyday families from moving companies that try to, hold their furniture hostage to extort more money. And the sheer density of financial security required to move an 18-wheeler from point A to point B is just staggering.
Which makes the contrast with the Canadian logistics system incredibly interesting. Because while the North American supply chain is deeply interconnected, the regulatory approaches are fundamentally different. The United States relies on this strict, bond-driven FMCSA framework. Canada, overseen by the Canadian Transportation Agency and the Canada Border Services Agency, operates on a very different philosophy.
The most glaring difference is that Canada simply does not require a federal brokerage license bond. There is no Canadian equivalent to the $75,000 BMC 84. If you want to open a freight brokerage in Toronto, you aren't forced to park $75,000 in a federally mandated trust.
Yeah, the Canadian system relies much more heavily on corporate credit profiles and general cargo insurance. When a broker or carrier faces a suspension of their operating authority in Canada, it is almost always triggered by a lapse in their insurance coverage, not a bond drawdown.
So the authority structure is totally different. Canada enforces strict bonds at the provincial and border levels, like the CBSA requiring a minimum $25,000 customs bond to move bonded freight across the border, or provinces requiring specific logging and oversized permit bonds. But they leave the broker-to-carrier financial relationship largely up to the free market and credit insurers.
However, the shift we've seen in the U.S. is creating a geopolitical ripple effect. The 2026 U.S. regulatory crackdown is actively pressuring Canadian regulators. Because freight moves seamlessly between Chicago and Toronto, having an ironclad automated tripwire system in the U.S. and a looser credit-based system in Canada creates an uncomfortable transparency imbalance.
It is contagious compliance. Fraudsters look for the path of least resistance. If the U.S. tightens the net and makes it impossible to operate a phantom brokerage in Ohio, those bad actors are naturally going to look at operating out of Ontario.
Yeah.
So Canadian regulators are now facing intense industry pressure to evaluate their own systems and consider implementing similar transparency rules for their non-asset intermediaries.
The transition from passive observation to active automated enforcement in the United States has fundamentally changed the risk profile of moving freight across the entire continent.
So to wrap this journey up, the era of set it and forget it, trucking compliance, officially died in 2026. The $75,000 broker bond is no longer just a piece of paper sitting in a dusty file cabinet at the Department of Transportation. It has been transformed into a living, breathing financial instrument, complete with mandatory rapid-fire reporting and automated tripwires that can shut a business down in seconds.
It's a whole new world.
It really is. So next time you order a package online or you are back on that highway driving next to a massive rig, remember,
Yeah.
it is not just diesel and rubber keeping that truck moving. There is a highly monitored, dynamic financial tether constantly pinging in the background, ensuring that the people doing the heavy lifting actually get paid.
This raises an important question, though. We have built a system of absolute instantaneous enforcement to stop fraud, and it works. But with these new automated systems instantly suspending a broker's authority the very second a bond dips below $75,000. Well, could this hyper-efficiency actually create accidental supply chain bottlenecks? Think about it. If a perfectly legitimate, complex dispute over a damaged load triggers an automatic suspension before the business can resolve it in court, could the very system designed to protect the supply chain inadvertently freeze it in its tracks?